We all know that real estate has created more millionaires than any other industry on the planet. We also know that it has created a lot of heartache due to mismanagement, overborrowing, and just simple life events that happen to all of us. Welcome to the CashFlowPro podcast. My name is Casey Brown, and I am your fearless leader. And although we might be bourbon sipping and at times foul-mouthed Southerners, we will always do our best to be honest, straightforward, and due diligent with all of the information we pass along to you. Welcome to the show. Hey there, and welcome to today's episode of CashFlowPro, your daily real estate investing podcast and YouTube channel. I'm here today with Jered Sturm of SNS Capital Group. And Jered and I were talking pre-show. He was telling us a little bit about his what he's got going on, and he's got a very interesting story that I think a lot of us can relate to. But before we get into it, I want to very kindly ask you to head down and hit the subscribe button so that you can be notified when we release new content and new episodes of the CashFlowPro, so that you do not miss our guests and their stories and potentially how you can move your capital raising business down the road and eventually make better deals, make more money, and raise money, and whatever it is you're into. But while you're there, also please leave us a review, 5-star review, I hope, and we would certainly very much so appreciate it. So, Jered, welcome to the show. How are you today?
I'm doing great, Casey. Thank you for putting the show together and allowing me to share my story with your audience. I appreciate it, and I know it's not an easy venture to put production like this together. So thank you for doing that and giving me a platform to share my story.
Absolutely, man. We're glad to have you and glad you could carve out just a little bit of time to be with us today. So why don't you kind of tell us a little bit about where you came from? And I know it's been a lot of work and a lot of hard work at that to get to where you are now, but we want to hear kind of how you started so the audience can have some context to what your background is.
Okay. Yeah. I've been in the real estate industry for, I've lost track of the years, but more than 15 years. And a lot of people will say, well, you're still relatively young. How is that possible? I actually got started pretty young. So I was 16 and I was a maintenance tech myself. So I was the person unclogging toilets and turning units and hanging blinds and doing those things while I was in high school. And so that's how I got my start into the real estate industry. And then that grew into starting a construction company, which then evolved into using the funds from the construction company to buy my own real estate assets. And that has grown over the years, but been in the industry for quite some time. I'm 32 now. And fast forwarding to present, we have about $100 million in assets, focus on the Cincinnati, Ohio market in multifamily. And but it has been a long journey from maintenance tech to this point. And I'd be happy to dig into any of that or give you a quick overview.
Well, first off, I know if you're in the Cincinnati market, you've got a considerable amount of competition up there, especially now. I think there's definitely been some that market has definitely grown, I would say, in the last 5, 6, 7, 8 years. I mean, it's always been a good market, but it's definitely kind of really got a little rocket feel. It's a little bit like Nashville in a way. It's just like all of a sudden people are like, oh, I want to move to Cincinnati. It's the same way as Nashville. People just woke up one day and they're like, hey, what are we going to do today, honey? I don't know. Let's move to Nashville, And so it's just kind of grown. It seems like it has a little bit of the same sentiment there. So, but yeah, so why don't you, so maintenance tech, man, I mean, that's such a, maybe people out there aren't necessarily maintenance techs, but I know, like myself, I started in housekeeping in a hotel. So, I mean, there's a lot of us that have those very base beginnings who now look forward and say, hey, yeah, this is what we want to be. So how did you learn? I guess that's the first thing I want to know is I want to set a basis for what clicked in your mind to say, hey, I'm going in and I'm going to be in the real estate business to start with, or maybe even the capital raising business, or how did that just click in your mind? What set that in motion?
I don't know if anything ever, I didn't have an aha moment But I think what set it in motion is I was not a good student academically. So the typical path never appealed to me of go get the corporate job and work that for a long time. But I was always very good at working with my hands. And then as I was a maintenance tech, I just never said no to anything. So I'd always get asked, do you know how to do this? And the answer was always yes. And really what the answer was in my head was, yes, I know how to figure it out, not yes, I know how to do that. And so when I would get the question, do you know how to change a toilet? The answer was yes, and I would figure it out. But that evolved into, do you know how to renovate a bathroom? Can you put in a new kitchen? Could you put an addition on my house? And the answer
Sure.
was always yes, and I'll figure it out. And then when it came time to say, do you know how to buy single family houses for investment? Yeah, I can figure it out. But it went from all of those things and just progressed of, I'm good at problem solving, and that's a universal skill. So whatever I'm doing, I'm good at that. Just solving it and moving and adding to my tool belt of skills I have, and using that to further whatever venture I'm in, whether it's changing a toilet or buying, a $10 million apartment building.
Yeah. Yeah. And that's, my grandfather, one of the most, I guess I don't say famous things I remember him saying when I was growing up was he would always state that he could wear a tuxedo or he could wear overalls. It didn't make any difference to him which one of the two he wore. He would do whatever he was doing to the very best. And that's a lot the same of what you're saying. It's one of those things where it's like, hey, whether you're changing a toilet, whether you're taking down like you said, taking down a massive apartment building, figure it out. That's what I always tell my kids. Just figure it out and problem solve and notch it up so that you can take one little step to get to that goal. And I love that. That's the part of your story that really makes people look out there. And that to me is probably one of the most important parts of your story is the problem solving portion of it. Mm-hmm. So with that being said, let's kind of move forward here and talk a little bit about maybe your first investment deal, like whether it was single family or whether it was multifamily, and then we can kind of move and how you've progressed into where you're at now.
Yeah. I think that's great. The first real estate investment we made, and when I say we, it was me and my brother, and still to this day is my business partner. First real estate investment we made was in 2008, June of 2008. Bought a single family house for myself and my brother to live in, and we rented 4 other bedrooms to friends. And so I consider that our first investment, which.
And what year was that? What year was that?
2008.
2008. So, man, that was like early on in the whole house hacking deal. I mean, we didn't even call it house hacking back then necessarily, but shoot. Yeah, man, that's killer, dude.
Yeah. And so and then what we were doing at that time is we were fixing up people's, like doing high-end bathrooms and kitchens or putting additions on people's houses, decks, porches, things like that. And then we would use those funds that we would earn from our construction company to go buy the worst house in the neighborhood and just substitute our lack of capital with sweat equity. And so nights and weekends, we would be working on these, really, really beat down houses and fixing them back up because we knew how to fix stuff, but we didn't have a ton of money. And so we would do the construction business during the day, nights and weekends, fix up houses. And then we made the wise decision, rather than just flip them and sell them, we actually were renting them out. And then it took us, I think, about 3 years to go from 1 house to 8 houses. But keep in mind, this was 2008 to 2011.
Yeah. Yep.
And I was, 18 to 21 years old without a W-2 job. So there weren't a lot of lenders jumping out of the bushes at me at that time saying they wanted to lend me money. It was a really challenging time to borrow. So the first 8 houses we had to do all cash. So save up money, delayed gratification, don't spend these big checks that are coming off these high-end kitchens. put it back into the house, buy a house, fix it up, cash, and then that wasn't by choice. It was just we had to. But then after 3 years and we had built up a track record and kind of proven out that we could operate these, we found a little local bank that gave us a blanket loan, cash out refinance, only 60% leverage. But I'll never forget that day, because that was when I felt like the snowball really kicked off and we were able to start using leverage. And so we pulled 60% of the equity out of all these houses that we had spent 3 years fixing up. And then we redeployed it into 10 more houses.
And did you at this point not owe anything on those houses that you'd fixed up? I missed that. Did you? If you said that, were you paying cash for the houses like all together?
Yeah, the first 8 we had to do cash because there was no one willing to lend to.
I didn't know if you meant cash for the principal of it, or cash like injection, like you were doing all the repairs. All right, so you were just paying cash for these houses from these high-end kitchen remodels, basically bundling it up into these single-family residences, 8 of them. Then you take the 8 of them and go to the bank and say, hey, man, we've got X amount of dollars worth of houses here. Will you make us a 60% LTV loan on these houses we own free and clear?
Correct. But I would add, just for the listeners, that we did that process with the first house and the second house and the third house, and we got no, we're not lending to you. We're in the worst housing recession we've ever been in. You're 19 years old. You don't have a job. No, I'm not lending to you.
Yeah.
And so we tried for 3 years to strip the equity out of our portfolio to accelerate. And then eventually we got one lender who gave us a very conservative loan on their end. But it was the day the snowball kicked off. I'll never forget it, because it was just such a large check relative to what I had ever seen. But again, we just used delayed gratification and self-discipline to say, rather than us go buy a bunch of things with this, we're going to buy more real estate investments. And then it just really snowballed from there. So it went from single-family houses. We bought about 70 single-family houses. Then we started buying duplexes, fourplexes, 10plexes, and then started buying 40-unit, 100-unit apartment communities. And we really enjoy the economies of scale and operational simplicity of large apartment buildings. So since, in 2020, we sold all of our smaller assets and just focus only on large apartment communities now. But I just whipped through a decade there. So,
So when did you, at what point? So you just basically gave us a 30-second, 10-year timeline of 870 duplex, quadplex, triplex ish stuff, then 10 plus units, basically, right? So your progression was basically bigger economies of scale as you moved along the line there. Now, with that being said, the reason I lay that timeline out, because my next question is, as I ask this, I want you to kind of keep in mind, but at what point did outside capital become either necessary or hey, better yet, did it become necessary to continue to grow, or did it become, hey, we can do this and scale higher, better, faster? What was the thought process, and when did that happen? At what point in that timeline?
8 years in. So that'd be 2016. So the first 8 years we did it just with our internal capital. Then we made the decision to go into the syndication model and raise money by partnering with passive investors to buy larger communities. And I think
by that time the Jobs Act had passed in kind of right in the, right? Because it started in 2012, 2013, right? That's kind of when it started looking.
That wasn't a driver behind our decision, so I'm not sure. It was just out of an internal need, and those needs are it was twofold. So one, we really enjoyed buying the larger apartment communities, but as you can imagine, those larger apartment communities come with larger price tags, and coming from a grassroots organic growth, there was only so much capital. So we have to find a way to inject capital into the business, because we can't buy as many apartment communities as we would like to buy and scale our business. So it did have to do with scaling our company, but at the same time, I have found a lot of fulfillment from 2016 to now in helping other people grow their wealth through the skills that I've spent a lot of time acquiring. And so, what our core competency is at SNS is really good operations and
Okay.
running these multifamilies to maximize value. And that's why a lot of our investors are attracted to us, is because they say, well, you know that, I don't want to learn that. I'll invest with you. And then I get to see, their financial freedom or financial goals come to fruition through the skills and effort that I put forth, which has become very fulfilling. And so I think it's two things there. We did need the capital to scale the business, but it's also part of fulfillment in life of like, are you doing good for others? And this is a way that I really can have a pretty significant impact on a lot of people.
Sure, sure. Yeah. And it also gives you the ability to give back and maybe shorten somebody's timeline, whereas yours was, like you said, 10 or 12, 14 years. You
Mm-hmm.
can condense that down if you can say, hey, skip the duplex. Like, for instance, I think I almost always feel like, and you can correct me if I'm wrong because I've been there, but I always feel like starting with single family residences is where everybody seems to go, because
Mm-hmm.
in a way we migrate to being the problem solver for, like you said, you can install a toilet or you can have an executive meeting with 10 people who are worth $1 billion a piece. It's whichever way. So you start with single family residences, and maybe you could even get somebody in there and say, hey, you can bypass even the single family residence part, or if you have 10 or 12 of those, you can bypass the duplex, triplex, quadplex scenario
Mm-hmm.
and go right into 10 plus units. It kind of just is a balance, whatever somebody wants. So I love that. Now, the one, I wanted to go back and dig into one part of this, because the psychology behind delayed gratification is something that I don't think a lot of people really pay attention to. And when you delay that gratification, I'm assuming you're talking about, hey, not stopping and saying to yourself, damn, we just bought a 10 unit complex. Let's go and let's gratify ourselves. Let's make things. I mean, I guess that's what I'm assuming you're talking about. But am I on the right line there? Because I like that term. I'm trying to put something with it.
Yeah, I think it is um, a valuable trait that all of us have at different spots on that spectrum. That's
Mm-hmm.
something that I think me and my brother were just raised with, and even it's just, you have to forego something good now for something better in the future. And the
Okay.
question is, do you have the discipline to wait, um, and the faith that you'll be able to see that come to fruition?
Yep.
And that's something that we're just naturally pretty good at, I think, just through our upbringing. And so, yes, it was when we did that cash out refinance, and we had, 6-figure check sitting in front of us when I was 21 years old. What did we decide to do with it? Right? It could have been buy the super nice car, go upgrade our own house, and have a whole new wardrobe. But no, I
Yep.
kept buying the thrift store clothes. I lived in the house with the 6 other guys I lived with. I drove the old Dodge Ram, and I bought 10 more rentals. And
Yep.
so the question is, like, are you willing to forego the benefit now for more benefit later? And I'll sum it up in a quote that I don't know who said it, but I've heard it over the years, is I've always said, I'm willing to live like most people won't, so that one day I can live like most people can't. And I'm
Yep.
very fortunate that I feel like I have reached the second part of that story
Yep.
now in my life, because I'm very happy to say I have enough. Like
Yep.
I'm constantly reminding myself of that. Like, I have enough now. My growth is for the fulfillment of progression, and not because I have to reinvest it.
Yep.
So anyway, that's how I would sum up delayed gratification.
Man, I think that, again, it's something that people don't put enough effort into focusing on, saying, hey, um, when I was in the single family side, I was a little bit the same way. People would say, well, how many rentals you got now? Oh, I don't know. I would say 30 or 35, 40 or something like that. And people would just it would just blow them away. And I'm like, look, listen, that's cool and all. I'm glad you're impressed, but I'm not. Let's go. Let's get up and keep moving forward. And that's, I think, so many people turn around and focus on the way back. And I think that also leads to, oh my God, I've got to go borrow $1 million or $5 million. I mean, these are numbers that people, when you're going to borrow that much money, these are numbers that people automatically put a capital, like they put a capital attitude towards. Like, you're going to borrow $5 million. What? That's crazy. That's how are you ever going to pay that back? Well, listen to me. This is how I'm going to pay it back. And I think a lot of that is it's a psychological shift that has to happen when people start realizing, oh, he's buying an asset that brings in monthly income, and then he's going to take that monthly income and he's going to make the payment, and then he's going to have some left over. I mean, and once you figure that part out, it makes sense. But I think it all starts with stop being impressed with yourself and stop being impressed with what you're doing and look forward, because the next deal is what matters. And then, like you said, getting to a point in life where you have enough. I love that, man. That's killer, because sometimes I wonder myself if that will ever happen. Like, if I'll ever be like, man, I'm good. If we get another 100 units, that's cool. If we get another 1,000 units, that's even awesome. And if we don't, whatever. So that's awesome. So let's talk a little bit about where your business is now. I know you told us what AUM you have, but what's the foresight here? What are we looking at? What do you got going on right now?
Well, the markets, as you mentioned, this is a nationwide comment, but are just highly competitive, right? There's a lot of capital chasing yield. We're remaining really disciplined with our core competency of operations. We're very focused on one market, which is Cincinnati, Ohio, which means there's less assets to go after and only so many transactions. And so there's times where we'll go, 15 months in between acquiring anything, but that's fine. We just stay disciplined to what we're looking for. And our investment philosophy is always to invest for consistent, predictable cash flow. And really, from the first house to the most recent $13 million multifamily that we bought, the business model has been exactly the same. So we haven't reinvented anything. It's buy something that we can force appreciation into, usually through construction and better property management. And then we strip the equity out of that after we force the appreciation, and then we reinvest that into another project. So it's not a highly sophisticated model, but it's a very proven one, not just from me, but from tons and tons of financially successful people. So we just do that over and over and kind of stay in our lane, right? We know the Cincinnati, Ohio market, we know our operations, and that's where we're kind of staying put because the pricing is so competitive. You don't want to get outside your lane and make a mistake.
Now, I want to talk a little bit about stripping the equity, because that's such a crux. Like that ends up being, this is where our business model works. Okay. Because if you're not stripping the equity and reinvesting, it makes it difficult. So with the stripping of the equity, obviously that includes a refi of some kind, I assume. Mm-hmm. And when you refi, do your outside investors stay in? Do you just pay them back and say, hey, thanks for your money? Or or obviously you're going to split. There's a back end split of some kind, I assume, but mm-hmm. Explain that part of the process.
Yeah. Well, I'll start by saying the Cincinnati, Ohio market is very, caters to our investment philosophy of consistent, predictable cash flow. So it's a good cash flow market. The majority of the time when we're presenting investment opportunities to our investors, we underwrite without the refinance event in there, because we don't know what the real estate or debt markets will look like in 3 to 4 years when we finally stabilize these assets. Mm-hmm. And so when our investors are coming in, we're saying, this is what it will look like if we don't strip the equity. Would you like to participate? And then if the real estate and debt markets support a refinance, we will absolutely pursue it and return your capital. Now, and then to answer your question on what happens when the refinance happens, because we've been very fortunate that all of our syndications have been able to return capital to investors through refinance events because the real estate market has been very favorable and debt rates have been very favorable. When that happens, ownership stays the exact same. So on our high level, what our structure is a 70-30 split of equity, 70% to the limited partners, 30% to the general partners, with an 8% preferred return. So if someone invests $100,000 and we do a refinance in year 3 and we return $100,000 back to that investor, they still own the same exact percentage of that entity that owns the real estate and will continue to get the tax benefits and cash flow from that asset. So our thought is it's an equity investment. They should share in the upside and share in it after the fourth appreciation.
Now, do you all have? So I've heard of this. I've heard of this model several times, and I always have the same question. So obviously, and I've heard actually some people call it infinite returns. Obviously that's definitely a pinch between being true marketing or not. I mean, infinite returns obviously is infinite, but eventually something has to happen. Is that asset on your outlook? Are you all looking to sell that asset at a given time, or does the investor just stay in does everything just move along?
Yeah, no, at our size, we are not able to confidently raise capital with an indefinite date on it.
Yeah.
So, I'm sitting here in my 30s, so a 10-year horizon, it sounds fine. But when I go to someone maybe in their 70s and say it's indefinite, that's not really as attractive to them. So what we have found is, again, our investment philosophy is for consistent, predictable cash flow. I think the way you achieve that is by owning real estate and operating it for the long term.
Mm-hmm.
The balance between those two things of consistent, predictable cash flow and acknowledging that investors eventually want their capital back. All of the projects that we've put together have had a 10-year time horizon on them.
Hi, this is Casey Brown, host of the CashFlowPro podcast and YouTube channel. Have you been thinking about investing in real estate but just don't know where to begin? I'd like to help by inviting you to check out our website at www.3000capital.com. There you will find an array of material that will help you learn all about real estate syndication. And while you're there, be sure to check out our free video series download titled 5 Must-Know Keys to Success in Passive Real Estate Investing. I'd also like to personally thank you for making CashFlowPro part of your day. Now, back to the show.
So a lot of times what we've been able to do is buy the asset, reposition it, and then hit a refinance in year 2 or 3, and then continue to own it for another 7 to 8 years, and then sell that asset. Okay. And there's going to be times where the investor pool might be smaller, and then everyone says, let's just keep the party going, and we don't want to sell. Or maybe there's 20 investors and 2 want out and 18 want to stay in. And at that time, I most likely would just step up and buy those 2 people out and give them the funds that they wanted, and we would continue to own it. Because my personal preference is, or my personal thought is, the way you build wealth is by owning real estate, not by selling it. So
absolutely. There's people that I've ran across, and most of the time it's in the agricultural world. Like there's no because people get attached to family farms and stuff. So that's part of the psychology there. But there's other people who are farmers who buy farms, and there's no price on them. None. I mean, let me back up. There's not a reasonable price on them at all. So, definitely that's a philosophy that if you're going to buy to grow or buy for capital events, that you definitely have to decide that model. So awesome. Well, listen, Jered, I appreciate you taking the time to be with us, man. And we've got a couple of questions that we ask every guest that comes on the show. And the first of those questions is, what is the best book that you've recently read or are currently reading?
I listen to audiobooks. That's my preference. Currently listening to Good to Great. I think it's one that a lot of business people have heard of. And I just never gotten around to listen to it. I'm listening to it now. It's pretty interesting. I don't know if I would say that's the best one I've ever read, but that is the one I'm currently listening to.
Awesome. Awesome. All right. Well, the next question, what is a dream vacation that you've either taken or hope to take?
I am when I vacation, I do a lot of planning and structure and visionary work at our company. So when I vacation, I don't want to plan. I don't want to do any of that stuff. And
Yep.
so I like cruise ships because all you have to do is get onto the boat and then you're basically done. So you don't have to worry about meals or Uber or car rentals or anything. You just get on the boat and you've done your part. And so I've taken quite a few cruises, and I have a 5-year-old and a 1-year-old, and they can accommodate kids as well. And so a cruise ship with a big room to accommodate kids is my ideal vacation.
Awesome, man. That's great. Well, sweet. So listen, if somebody heard something that resonated with them, or maybe they even want to discuss being an investor because they love the Cincinnati market or whatever, what is the best way for people to get in touch with you?
Through our website, there's plenty of, once you're on the website, there's plenty of ways to get in touch with me or someone on our team, but our website is SNS Capital Group. So that's 3 letters like Sam, Nancy, Sam, capitalgroup.com.
Awesome. Awesome, man. Thank you so much. Again, thank you for being on the show today. We really appreciate it. I know the listeners, there was tons of stuff in there that people can relate to because, man, just ultimately when it comes down to exactly who you are, what you are, it's just you have a form of grit about you that just says, hey, I'm going to get this done and I'm going to learn from it. And then after that, I'm going to leverage what I learned and move up to the next notch. And again, I think there's tons of lessons to be taken just from that simple scenario that I just basically summarized your whole first 20 years in the business, or 10 years, 15 years in the business as. So, and it's always about moving up and getting better and doing what you're doing today better tomorrow. So I can't thank you enough for that, Jered, and thank you so much. Listeners, as always, please head down, and as I stated earlier, leave us a review, leave us a 5-star review. We really would appreciate that. And don't forget to hit that subscribe button because you want to be notified when we release new episodes. And again, I want to thank everybody for your time. Jered, thank you again. I hope everybody has a wonderful rest of the day.
CashFlowPro is hosted by Casey Brown, founder and CEO of 3000 Capital, a commercial real estate investment firm committed to providing its investors with ongoing cash flow and helping them build long-term wealth. If you enjoyed today's podcast, make sure to hit that subscribe button so you'll be notified about all our future episodes. You can find more information about us and our investment philosophy by clicking the link in the show notes below. Thanks for listening.